Welcome back to Investing Talk podcast. Today, we're honing in on, well, one of the most explosive turnaround stories we've seen this year, a company that, frankly, looked like it was on the ropes just 12 months ago.
Oh, really given up for dead by many.
Exactly, but it has staged just a dramatic comeback. We are talking about Opendoor Technologies. It's gone from, near-death status to this growth monster almost.
It's quite the narrative.
So the big question we're tackling today for you, our listener, is pretty straightforward. Is Opendoor Technologies a good time to buy right now? And hey, if you find this analysis helpful, please do remember to subscribe, like the show, and drop a comment below. We really appreciate it. Also, if there's a specific company you'd like us to look into next time, just leave the name in the comments. We do check those.
Yeah, we do. And analyzing Opendoor right now is, well, it's fascinating, isn't it? Because the price action has been, frankly, unbelievable. But separating the, let's say, the hype from the actual foundational reality requires a really disciplined look at the sources. So our mission today is basically to unpack all these complex forces driving this recent run. Everything from, that radical shift in profitability to the extreme technical momentum we've seen. And the goal is to help you synthesize whether the risks of jumping in now after such a surge are actually worth the potential rewards. And this is all based on our collected data as of October 1st, 2025.
Okay, let's start with the fundamentals then. We need to really understand this pivot because the old Opendoor, it was just a volume game, right? Often losing money on each sale.
That's absolutely right. The core story here is this dramatic pivot, moving away from that high-volume, loss-making model you mentioned towards one focused on disciplined, sustainable profit. Think of it as a shift from quantity to quality. And if you look at the revenue context, the numbers are quite staggering, but they really prove the strategy worked.
How so? Because the revenue actually dropped significantly, didn't it?
It did. Full year 2024 revenue was about $6.87 billion.
Right.
Now, compare that to $15.6 billion back in 2022. It's a huge reduction.
Aggressive.
Yeah, but that drop wasn't just the housing market cooling off. It was actually a deliberate choice by management. They called it internal inventory optimization. Basically, that $8 billion cut showed they could actively manage their risk. They stopped chasing scale at all costs and focused ruthlessly on efficiency, on getting their pricing right.
Okay, so they consciously shrank to get healthy.
Yeah.
And that strategic cut, that's what allowed the profitability to finally come through.
Precisely. That's where it gets really interesting, the profitability inflection point.
The margins.
Exactly. The company hit a gross margin of 10.1% in Q2 2025.
Wow, 10.1% after being negative before.
Yes, which is huge. But the critical question for you, the listener, is this sustainable? Was Q2 just a one-off cleanup? Or have they actually stress-tested this margin in a more volatile market? Well, the sources suggest this 10.1% is kind of a proof of concept for their new model. For an iBuyer, remember, that's a company using tech and capital to instantly buy and quickly resell homes. That margin isn't just profitable. It's
the whole ballgame.
It really is.
Yeah.
It's the difference between running a highly efficient, tech-driven operation and basically running a constant fire sale like they arguably were before. It shows their pricing algorithms are finally perhaps accurate enough to handle housing volatility.
And that margin improvement fed directly into the bottom line, showing that operating leverage everyone looks for.
Exactly right. That operational discipline led straight to a Q2 2025 net income of $42 million.
$42 million profit after those huge losses.
A significant reversal from the massive net losses they were racking up throughout 2023. And this is why analysts are now projecting positive earnings per share EPS for the whole of 2025.
Which would be huge for the whole iBuyer space, really.
Monumental.
Yeah.
And crucially, this new disciplined approach, it's supported by a surprisingly strong balance sheet. They didn't just cut costs. They actually built up a war chest. If you look at their mid-year snapshot, June 30th, 2025, they were sitting on $1.03 billion in unrestricted cash.
$1 billion in cash.
Yeah, and over $2.4 billion in available liquidity overall.
That $1 billion, that's a serious safety net. It means they aren't forced sellers in a down market, which, like you said, was the death knell of the old model.
Absolutely.
And they've been deleveraging too, right? Getting the debt down.
They have, which is essential with rates higher. Now, total debt is still substantial, around $3.5 billion.
Yep.
But the key metric, the debt-to-equity ratio, has really improved. It's fallen from over 2x in 2023 down to 1.2x now.
That signals much better financial health. Maturity, almost.
It does. And we see that confirmed in their cash flow discipline, too. They reported positive operating cash flow of $54 million in Q2 2025.
So generating cash from operations now.
Exactly. It suggests they're moving towards potentially self-funding future growth, maybe even doing some opportunistic share buybacks eventually. Less reliance on external financing.
Okay, so the model seems healthier, more disciplined, but what makes Opendoor defensible? What's their moat against, traditional brokers or even other tech platforms trying to get in?
Well, the moat is still largely driven by their scale and their technology. They are still the leading iBuyer, highest transaction volume, widest geographic reach, and all that feeds their proprietary data machine.
Better data, better pricing.
That's the idea. They claim superior pricing algorithms and this vertically integrated process. It allows for much faster closes, tech-driven cost reductions, things traditional brokerages just struggle to match.
And they're not just going it alone anymore, are they? I saw something about partnerships.
Right. Their strategy for the second half of 2025 includes these exclusive partnerships with key brokerage networks and local realtors. It diversifies their buyer pipeline.
So moving beyond just direct-to-consumer, integrating more.
It's exactly. Integrating more deeply with the traditional real estate ecosystem. It spreads the risk.
Okay, so the fundamental story is compelling. A genuine turnaround, it seems, based on financial discipline.
It does seem that way.
Yeah.
But honestly, the momentum we've seen in the stock lately, that's been driven just as much by technical factors and, frankly, market psychology as by that 10.1% margin.
Right. Let's cross over to the ticker tape now, because this is where it gets kind of wild.
Yeah.
Did the fundamentals cause this surge, or did they just give permission for the traders to pile in?
That's always the question with these moves.
I mean, to go from a 52-week low of 51 cents to trading near $9.50 as of October 1st. That's what, a 498% year-to-date gain?
Incredible numbers. And 337% over the past 12 months.
That kind of explosive price action, it just grabs everyone's attention, doesn't it?
It absolutely does. And if you look purely at the technical health, the stock is strongly bullish. The moving averages tell a clear story.
Where is it trading relative to those?
It's well above its 50-day average, which is sitting around $4.95. And critically, it's miles above its 200-day average, way down at $2.07.
Okay, so crossing above those key long-term averages signals a big shift in trend.
A clear and powerful shift, technically speaking. And what's interesting is the consensus view sees a near-term bullish trading range, sort of between $9 and $10.50.
So support and resistance levels.
Key support levels to watch are around $7.50 and then that $9 mark. That's likely where buying interest might step back in on dips. But the immediate resistance, the ceiling for now, seems to be right in that $10 to $10.50 zone.
But surely this kind of rally pushes the stock into, well, dangerous territory, overbought maybe. The warning lights must be flashing.
Oh, they absolutely are flashing. The 14-day RSI, the relative strength index, is high. It's sitting at 74.5.
And above 70 is usually considered overbought, right?
Technically, yes. It measures the speed and change of price movements, and above 70 often signals that a correction might be due. Red flag territory. But, and this is key with momentum stocks, that high RSI can actually be sustained for weeks sometimes. If it's fueled by fresh positive news and, shifting sentiment, it can stay elevated.
Which brings us to sentiment, because you really can't talk about this rally without mentioning the whole meme stock angle, can you? This wasn't just cold, hard math driving the price.
Not at all. It was emotion narrative.
What were the triggers there?
Two key events really lit the fuse for that narrative surge. First, the company achieved Nasdaq compliance. That allowed management to cancel a planned reverse stock split.
Okay, took away a big negative overhang, stability restored.
Right, removed a huge psychological barrier. But the second event, that was electric. The September leadership overhaul. The co-founders, Keith Rabois and Eric Wu, they returned to management roles, and Kaz Najatian was appointed CEO.
And that was the spark.
That specific change, around September 10th, it triggered what really felt like a meme stock-style rally. The share surged, up to 56% in a single day. It wasn't just a new CEO, Rabois and Wu coming back. It signaled a definitive break from that prior aggressive, loss-making growth strategy. It felt like a return to the core technology focus that originally gave the company its edge.
So it restored faith that the tech driving that 10.1% margin was actually being prioritized again.
Exactly. And that narrative, it was instantly picked up by retail traders. Reddit, StockTwits, massive social media engagement. This idea of a huge comeback supported by a real change in leadership.
Yeah.
That's a powerful story.
And this is where it gets interesting, where the retail excitement perhaps gets validated by the big money, right? Institutional buying.
Yes, we are seeing reported increases in holdings from major funds. Think BlackRock, Vanguard. When the fundamental story genuinely changes and the operational turnaround looks real, institutional investors often start to follow that momentum. it can provide a kind of floor under the retail enthusiasm.
Okay, so we've got improving fundamentals, incredible technical momentum, and this powerful narrative shift. What does this all mean for the next few months? Let's look at the near-term catalysts, the short-term view.
Right. The most immediate and probably the most critical test is their Q3 2025 earnings release. That's scheduled for October 29th.
High states for that one.
Extremely high stakes. The market has priced in very high expectations now. They absolutely must prove they can sustain that crucial margin improvement. And they need to meet their updated revenue guidance, which is between $800 and $875 million for the quarter.
And if they miss, given that high RSI,
Any failure to execute there could instantly trigger a pretty deep correction. The air is thin up here, so to speak.
what else should we be watching for in the near term?
We should also be looking for concrete results from that distribution expansion they guided towards. So more major brokerage integrations, maybe some fintech tie-ups.
Proof that the partnership strategy is working and scalable.
Exactly. Showing they can grow without resorting to just aggressive loss-making inventory buys.
In technology, they mentioned new tech rollouts.
Yes, they're rolling out new tech innovations, specifically enhanced appraisal and valuation tools, supposedly powered by AI. Those are due in the next quarter.
And if those tools boost conversion rates or pricing accuracy even slightly,
That provides a clear, measurable efficiency bump, something Wall Street can easily plug into their models for future growth. It validates the tech story.
okay, that covers the near term. What about thinking longer term, beyond the next quarter or two?
Well, looking further out, the biggest structural driver is probably just the broader housing market recovery. If we see a sustained turnaround in mortgage rates or just general housing affordability improving.
That could fuel a multi-year upcycle for these tech-first brokers.
Precisely. Opendoor seems perfectly positioned to capitalize on that kind of demand surge if and when it arrives.
And we can't ignore the speculative buzz, can we? There's always chatter.
Always chatter. There is this persistent, though completely unconfirmed, talk about potential acquisition interest, maybe from a major real estate portal.
Right, the takeover rumors.
If something like that were to actually materialize, it would obviously drive an immediate valuation premium. Plus, there's some speculation, even more speculative perhaps, about a possible international launch, maybe Europe. But that's really just noise for now.
Okay, which brings us to the necessary counterargument, the risks. Because a turnaround story this dramatic always carries significant danger, doesn't it? Can they actually execute this while dealing with all this volatility?
Absolutely, we have to lay out the risks. The primary one is simply execution risk. That whole margin recovery thesis, that crucial 10.1% margin, it hinges entirely on maintaining inventory discipline and the accuracy of their tech underwriting.
If they slip up there.
If they misstep, if their algorithms start overpaying for houses again, they would quickly see inventory write-downs and losses return, and that would just destroy the investor confidence they painstakingly rebuilt.
And the macro environment hasn't just vanished, right? Those sector-wide risks are still out there.
Correct. Macro headwinds, think elevated rates, ongoing home price volatility. These remain risks for the whole sector. Even though Opendoor has shown maybe a better ability to adjust inventory quickly this time around.
They still operate within the broader housing market.
Exactly. And if the housing market freezes up due to external factors, even the smartest algorithms can struggle.
Any other major risks?
Finally, you have to note liquidity risk. Yes, their cash position is strong right now, but their working capital model, it relies heavily on credit lines to buy properties. If the housing market were to suddenly seize up and they couldn't sell inventory quickly,
That reliance on credit could become a real pinch point.
it could become a significant pressure point, yes.
Okay, so pulling it all together, fundamentals improving, massive technical momentum, strong narrative, but also real execution and market risks. What's the synthesis here?
So based on the sources we've reviewed, the overall rating we're seeing for Opendoor Technologies comes out at an 8.5 out of 10. That puts it firmly in the bullish category.
An 8.5. Pretty strong.
It is. And it's driven mainly by three things. That robust cash position providing a buffer, the undeniably powerful technical momentum, which has been sustained by that narrative shift, and, crucially, a credible operational turnaround story. It seems proven, at least for now, by those structural improvements in margin and the positive net income.
So what does that mean for you, the potential investor? How should you think about this?
Well, given that inherent volatility we discussed and the near-term catalysts like Q3 earnings, the doc looks potentially attractive for short-term trading, leveraging that momentum maybe into the end of the year.
Yeah.
But
But the structural shifts, the proof that maybe, just maybe, the iBuyer model can be profitable sustainably, that makes it arguably compelling for long-term investment too. Capitalize on what could be a real evolution in how real estate transactions happen.
so potentially attractive for both horizons,
Yeah.
depending on your risk tolerance.
That seems to be the takeaway. And just to leave you with a final provocative thought to chew on, remember, despite stop trading near $9.50 right now,
The consensus average analyst price target is still way down at only $2.36. That reflects all the pessimism from their really rough patch.
wow, that is a massive gap between the current price and the analyst consensus.
It's enormous, and it raises a really important question. When, or maybe if, institutional analysts finally catch up to this proven operational turnaround and the huge shift in market sentiment that's clearly happened, well, how much further could that adjustment fuel the current price trajectory?
That analyst catch-up could be the next major catalyst in itself.
It very well could be. Something to think about.